We have a newsletter that should be coming out soon. Certainly harass Tracy about that because she's working on it. And that will have the links to
Don't
all our
harass
recorded
me.
videos and all our other content. I'll get started with an interesting story. So I get up pretty early and I have about 2.5 hours in the morning where I drink my coffee and catch up on the news and do all that kind of stuff before anybody even starts to budge in the house, which is some of my favorite time. Part of that time, I had a conversation with AI just as a measure of what AI potentially could do for the economy. So the beginning of the conversation was about how theoretically Coke costs about $1 a can. So currently they make anywhere from 10 to 15 cents per can. With AI implemented throughout, it was estimated that it would add another 15 to 25 cents to the earnings. So if they kept the price the same, they would more than double their earnings. That's not including if they took all of the supplies that they received, the aluminum, the sugar, the storage, all of these different things that are part of the supply chain. If all of those were AI, it would bring the cost down to about 30 to 35 cents a can, which would mean if they kept the price at $1, they'd be making somewhere around 65, 70 cents per can. So 200% return on their cost. Ultimately, I think what would happen is you'd see prices come down. And so that's the case for deflation of items in the future as AI becomes more and more prominent. And we've all heard the Terminator version of the story, and hopefully we don't go there. Kind of another side note, funny story. My son, who's 13, is really interested in coding. And so we had a conversation about that. And he's like, I still want to know how to do it. And he came up with the idea of, okay, I'm going to learn how to code to shut down AI if it ever needs to be shut down. So that's the Terminator side of the story. All of that being said, AI is going to completely change the way we invest and completely change our economy. It's already starting to happen, but does that happen fully within 5 years or 25 years? Who knows? But we can invest accordingly for either scenario.
Yeah.
Yes.
I didn't fully understand how AI decreased the cost of, how does it do that?
Yeah. So at the corporate level, what it would do is it would replace employees and employee healthcare. So you wouldn't need people along the line filling up the cans and putting them in a box, and it would be all machinery. You wouldn't need people doing the marketing. A lot of that would be automated. And that goes into a whole nother side of what happens to all the people that no longer have a job, which is an inevitable thing that is going to happen. So for many of you that are retired and that first day of retirement, you kind of don't know what to do. That's what a lot of the population is going to go through at some point. And we can see it as a positive or a negative. We can see it as all the things that you would do if you weren't working are the things you can do going forward. How do we fund that? That would partly be through deflation, so the cost of items going down, and also the amount of income for those companies would go up, which would mean the taxation that they're paying would go up. So theoretically, the people that are no longer working wouldn't have to pay taxes. The corporations would more than replace the taxes that those humans are paying now, and that would create a basic income for everybody.
If we're out of a job, if we're not working, where does our income come? Who's going to pay us?
The government would. It would be a basic income coming from the government, like Social Security.
Okay.
And then the cost of items would go down because the majority of the cost of the items that we purchase on a daily basis is the cost of humans and their healthcare working in those companies. So everything would theoretically come down in value. Okay, so that was just a little side note on my morning. Let's go ahead and get started. So we've kind of touched on a bunch of topics in order: valuation, how to invest when things are highly valued, how to invest when things are low value, raising the floor, making sure that there's a maximum amount you can lose in a given year, and you do that by reducing your risk, importance of being on the right side of interest rates, meaning receiving money, receiving interest versus paying it. Today, we're going to talk about alternative investments. And then next month, we'll talk about the importance of cash flow. So we'll go ahead and throw all of these up there. Again, these are just bigger reviews of what we've done so far. And we'll just jump into it. So alternative investments are investments that are non-correlated to the stock market. So when stocks are up or down, it doesn't matter. These assets can be up or down as well. They're not tied to those results. And some perfect examples are gold and silver and real estate. Those are all ones we've touched on in the past, and many of us are invested in currently. So non-correlated assets are investments that don't rise and fall in lockstep with the stock market. So when the stock market goes down, they can be up, they can be down, they can stay sideways. When the stock market rises, they can lag, they can add stability, they can just pay interest. Think of them as kind of different engines powering your financial momentum. So at any given time in your investment history, you may have stocks doing really well and other things doing poorly. A perfect example of this, we've gotten a whole microcosm of this over the last 6 months or so. Silver and gold did incredibly well during the first quarter of this year, up 50+% over that period. And then we jumped into Iran, and that kind of stalled everything except the stock market. The stock market kept moving up, although it's been down the last week or so. But it stalled gold and silver. Gold and silver started coming down. And ultimately, what we've seen is the people that were in the gold and silver trade have actually moved to the oil trade. So when oil went from 60 to 110 a barrel, these people jumped into the oil trade to make money there. And it softened the trade on gold and silver. Not ironically, we've seen gold and silver, when oil comes down significantly, gold and silver go up. So we're seeing a little bit of a trend there. That doesn't mean that trend will continue going forward, but it's something to keep an eye on. So as things start to resolve in Iran, you're going to likely see gold and silver start to go back up again. The need or demand for gold and silver has not gone down. So there's still a huge demand for it. So that's just an example of kind of what we've seen. So as we look a little deeper into the alternatives, if you have alternatives in your portfolio, you're less dependent on one outcome. So for example, the typical investment portfolio might be 60% stocks and 40% bonds. So what happens when interest rates are rising and the market's falling? All of your assets are coming down at once. But when interest rates are rising or inflation is rising, oftentimes gold and silver are going up. Oftentimes real estate is going up. And so you have these pieces, these levers that while some things are coming down, others are going up. And so that's the whole key of what we're doing. And when we talked about raising the floor last time, what those other pieces do is, even if the stock market is down 50%, you have these other pieces that can eliminate some of that downside at the same time, which number one allows you to stay invested, and number two allows you to get decent returns in years where maybe the market is down. So we'll dig a little into each of these. Gold tends to hold its value or even move up in value. Silver has that same component to a much lesser degree, but also has a very high industrial need. So all of the new electronics, AI, data centers, all of those things require silver and copper. And so as that demand rises, you see the price of silver rise. I think you're going to see that going forward as these data centers and other things go online. Digital assets, you have some of these which you can do contracts, smart contracts. An example of that might be selling a home. Rather than using a agent, somebody buys your home and it's all contingent on the money being available. And once the funds are in the escrow, it automatically transfers, the title automatically transfers to the new owner, and you don't have to go through that whole process of going and notarizing and the 45-day escrow and all of those different things. So that's an example of a smart contract. And then finally, real estate. Real estate tends to go up when inflation goes up. We saw that a lot over the last 6 years or so. We've kind of seen prices settle, and we're seeing a decrease in rent prices currently. So where you would normally see rents rising, we're actually starting to see nationwide rents dropping. And there's a number of factors to that. One is interest rates have come down a bit. Another is we've had approximately 3 million folks either self-deport or be deported. And so those are 3 million people that are no longer looking for housing. So the demand for housing is going down over time. Again, this is a non-correlated asset. It's something you can invest in that works independent of the stock market. So really what I want you to take away from this is, number one, this allows us to invest like Warren Buffett. So number one rule of investing, buy low, sell high. What this allows us to do is stay invested even when the stock market's coming down. And then when there's an opportunity, when stocks are fairly valued again, fairly or even undervalued, it allows you to shift to that more traditional 60-40 mix, or more towards the 50 to 60% in the stocks. You still want to keep some of your alternative investments, but when the risk goes down, that allows you to jump into stocks. It allows you to weather any kind of economic situation. Historically, the all-weather portfolio, when this portfolio moves, it averages 9.5% per year. And when it has a down year, the floor is down 12.9%. That actually happened in 1929 with the Great Depression. So we've got a floor that's much higher than the floor of the overall stock market, which is important when you're looking at valuations as high as they have been lately. Being on the right side of interest rates, this again is to make sure that you're earning interest. So a lot of our treasuries and other investments continue to pay interest. If they're in a taxable account, they have a tax benefit in that they're not subject to state tax. So California doesn't get any of that interest you earn. And then again, using those alternatives makes it so it takes some of those bumps out of the road as we're investing. Last thing I want to say on this as we go to questions is I actually got the question this morning from a client via email, and this will be a question that I address in our Ask Matt a Question live today. And it was, I heard on TV that a lot of the larger brokerage firms are saying we should sell our stocks, take profits, and go away for the summer. So if you were in a 50% or more stock portfolio, I could absolutely see taking some of the gains off the table and doing that. So I'll go into much more detail in our Ask Matt a Question later this afternoon, but any questions? So this is a session that I do twice a week where folks send in questions, and if they don't send in a question, I just take a question I get asked often and answer that question for the benefit of other people who maybe wouldn't ask it or hadn't thought to ask it. And so that's a live that we do at 3:45 Fridays at noon, and then again it's recorded, so all of those are available on our YouTube.
So you have a YouTube channel now?
Yep.
Okay.
Okay. Thanks everybody for coming today. I hope you got some value, and we'll talk to you soon.
All right.
Thanks, Matt. It's great.
Take care.